Let's put the spotlight then on all that was announced in the budget from a macro standpoint and also talk a little bit more about the overall liquidity situation at the current juncture. The markets are perched at about 24,500 levels. Joining in right now is Neelkanth Mishra, Chief Economist, Axis Bank and Head of Global Research at Axis Capital. Thank you so much for taking time out and joining in. Neelkanth, let's just begin then with the overall outlook this time around with respect to the budget and the Finance Minister clearly retaining the FY25 CAPEX target at about 11.1 lakh crore rupees. How do you believe that one should be reading into the fine print?
This was the first budget of a new government. So there were two major asks from it, or at least two major signals that we were all looking for. The first was, will the direction of the fiscal math change? There was, I think, apprehension among some quarters that that the government, because of the election verdict, would change its stance. So at least on the budget arithmetic, it is very clear that the government sticks to the focus on macroeconomic stability, on a very relentless focus on bringing down the cost of capital over the medium term. And I think some of those changes will start becoming visible in the next year or two. The second big message from the budget was through the budget speech, because as the first speech, it gives a signal on what the government's priorities will be over the next 5 years. And those, again, I think, lay the roadmap for simpler taxes, simpler customs duties, a focus on urbanization, focus on infrastructure development. So all of these, energy security, so all of these contours, or in making India a product nation, these perspectives, I think, were very useful from the budget as well. Some of the clarity, the fleshing out of these medium-term plans should start becoming visible. The finance minister signaled that at least a simplification of customs duties and personal income taxes should be ready in the next 6 months, which means the next budget. So FY26 budget, which will be published on 1st Feb 2025, we should start having clarity on several of these parameters as well.
Right. That's the thing, Neelkanth, because the observation has been across, markets and, people we've been speaking with, that it doesn't deviate a whole lot from the interim budget. But at the same time, it's kind of promised, or rather delivered, what the anticipation was. It's done decent enough bit for consumption, higher capex, lower fiscal deficit target. All of these are clear positives. Other than the capital markets taxes, there's nothing outright that you can pinpoint that wasn't delivered that you did hope and pray for.
Yeah, even on the capital gains taxes, frankly, if you parse through all the comments made by senior policymakers, I mean, the people in the finance ministry, RBI, SEBI, I think the concern on froth in the stock markets, and also I think the desire to reduce distortions or remove distortions in the plumbing of savings, where the savings are flowing because of the differentials in tax rates. I think those, so it was, I think, reasonably clear if you were looking at and reading the tea leaves that taxes would go up. Frankly, people were apprehensive that this number could actually be 15% or 20%. So the fact that it is from 10% to 12.5% appears quite marginal. So instead of pushing equities taxation to where fixed income was, they've actually brought down the taxes to the taxes on most of the asset classes to where closer to where equities were. So frankly, even that is not a big negative. I think going forward, the message that frankly I've been giving the last 10 years is that, look, the budget is about presentation of the ins and outs of the government's consolidated fund, which is how much revenue it is getting and where it is spending it. And there is going to be increasingly even less to talk about in the budget. It is, as you see, predictability. What was remarkable about this budget for me was how predictable things were, given that there was supposed to be a 70 basis points consolidation, and the provisional deficit in FY24 turned out to be 5.6, not 5.8, which were then the revised numbers. So it was reasonable to expect that there would be another 20 basis points in the revised numbers for FY25. Similarly, the fact that the gains from RBI dividend were one-off in nature, that they would be spent in a way which was one-off, so it was used to bring down the fiscal deficit. It was also used for CAPEX loans to states. I think those make it very clear that the government's behavior will be predictable, and that's actually extremely important for the private sector to get the confidence and start investing again.
I want to pick up on the point about consumption, because some of the critiques, Neelkanth, would say that allocations at a household level are not enough to really spur the kind of consumption that one anticipated, and especially to try and prop up the rural end of the economy.
Every doctor, when they are delivering a medicine, also looks at side effects. So the first constraint for the government, and we should keep that in mind, because because of the pandemic, the debt to GDP is at a very high level. So 80% debt to GDP at a general government level is very risky. I mean, in fact, if there was to be another, say, some global crisis, and we may actually start getting into a debt trap. So I think the cognizance of the fact that our debt to GDP is very high has to be there. In that context, you need to keep bringing down your fiscal deficit. So that's again then becomes a binding constraint. You cannot bring it down too fast, because if you do that, you slow down the GDP, and then your debt to GDP starts to go up. Now, therefore, every rupee that you spend has to have a multiplier. So if you hand over money to people, they will spend it, but after that, what? However, if you spend it on infrastructure, as you rightly said, the construction of the infrastructure creates jobs and demand and all that, but then the use of that infrastructure then drives productivity growth. And therefore, as the government in this period, and this period is going to last several years, needs to be extremely responsible on the multiplier effect of the spending it does. In that context, I think the space for doing significant amount of consumption stimulus is automatically constrained. The government then, but it has, there's been the one change I noticed was a nod to job creation. I think the acknowledgement that there is slack in the labor market, the economy is still 1.5 years behind where it should have been if the pandemic had not happened, means that there are about 1.5 crore people, 10-15 million people who are additional, and a surplus and looking for jobs. And how do we incentivize that? So I think the fiscal allocation there, about 100 billion rupees, 10,000 crores, is not very substantial, but the intent is clear as to that we need to start creating jobs. So I think direct stimulus can very quickly become constraining. So state governments, you may have noticed, 10 states of India are now running income transfer schemes, which add up to 1.8 lakh crores, 1.8 trillion rupees, 0.6% of GDP. Now, for the government to launch a scheme which was way bigger than that, I don't think there was enough fiscal space.
Right. If I could also just get in your outlook then with respect to the entire CAPEX theme and the fact that the defense CAPEX this time around was unchanged, the overall budgeted expenditures we discussed as well. For the entire industrial sector, do you think that this came as a bit of a disappointment, or would more have been expected on this front?
See, remember that the government, like any organization, your organization is a pretty big one, so is mine. I think middle of the year, changing spending plans in a big way is very difficult. I think if someone was expecting a big revision to spending targets in any department, I think it was an irrational expectation to start with. The direction of travel, in fact, going forward. So given that the government has said it will bring down the fiscal deficit to 4.5% next year, there is no further space also for the government, the central government, to start spending in a big way. Meaning that if you have to bring down the fiscal deficit by another 40 basis points next year, you have to keep the CAPEX as a percentage of GDP the same. You have to hope that your tax to GDP improves a bit, and your revenue expenditure, because it is not growing at the same pace as nominal GDP, can come down a bit. So in that context, and plus, the areas on which the central government can spend, national highways, railways, major ports, telecom, and airports, I think most of these, the expenditure is already at what I would call the peak level, meaning the maximum that can be absorbed. I think railways for the next 3-5 years can go up to 4.5-5 trillion rupees of capex, but among the rest, perhaps you don't need to do more capex. So therefore, the government is actually transferring funds to the states, and that's where I think a lot of the interesting projects are starting to happen. So when we think about the industrials as a sector, the investment cycle, we have to keep in mind that the real estate cycle is turned. One of the major reasons why capex was, as a percentage of GDP, was falling for most of the last decade was that the real estate cycle was on a downturn. As the real estate cycle starts to pick up, the demand for input materials like cement, steel, tiles, lots of other things start to go up, and that drives capex. I mean, if you talk to any aluminum supplier today, they'll say that there's such strong demand from cables and wires, from some various components, the things that go into windows. I mean, that there is a shortage of aluminum in India right now. So there is likely to be, as the real estate cycle continues, a pickup in the investment cycle as well for manufacturing. There is also on the energy side there are very clear signs that India needs to add capacity now. Many of these announcements have happened now. As they start to hit the ground, meaning the actual expenditure does not happen in the first month. As we start to see expenditure on some of these expansion plans, I think the capex to GDP ratio will start to go up. I think it's very likely.
Interesting point. Thanks, Neelkanth, for that.
If you like this video, then like, share and subscribe to ET Now.